Hello everyone, my name is Kavneet Singh Hanspal. I will be walking you through the course to help you master US taxation. We will be looking through different components of how do you stay compliant with tax laws, tax planning and optimization, your professional development in accounting concepts, tax concepts, preparation, and even advisory roles, risk mitigation so that you don't file incorrect returns leading to audits, penalties, and other legal consequences, and then empowerment and independence for individuals and small businesses who understand these tax forms and can properly file them for their own on their own. So we will be going through 7 modules of theory, and there all will also be practical modules to help you understand the concepts. The theory concepts will revolve around introduction to taxation, the US tax governing bodies, introduction to business ethics and tax filing software. Then we'll be looking at business entities in more detail, such as S corporations, C corporations, partnerships, and individuals. At the end, we will look at tax planning and compliance from an overall perspective. There will also be assessments for you to help you answer the questions yourself and check if you understand them properly or not. So yeah, I welcome you all to the course, and let's today begin with the first module, which is Introduction to US Taxation and the US Tax Governing Body.
The agenda for today's session is overview of US income tax system, future trends in US income tax, a brief walkthrough of how the early taxation was in the US, introduction to taxation principles like income, deductions, credits, and tax rates. What is the role of the federal bodies, IRS, Department of Treasury, Congress? Looking more in depth for Congress's role considering state revenue departments, state legislators, and the role of local authorities like county and municipal tax authorities. Understanding the US income tax system is essential for both residents and businesses operating in the United States. Taxation is a means by which governments obtain revenue to fund public services and infrastructure. Taxation is the rent you pay for staying in a country or operating in a country. That country provides you resources, and to fund those resources, it collects tax from you from different sources. This presentation explores the fundamental principles of taxation, the federal, state, and local governing bodies involved in taxation, and how they interact with taxpayers. The complexity of the system can be daunting, but grasping these concepts will provide a clearer view of one's obligations and rights. As for residents, it is important as it clarifies their obligations and rights. It helps individuals navigate the tax responsibilities more effectively. For businesses, the tax system comprehension is crucial for compliance and strategic planning. Understanding the tax landscape can help accelerate their growth and be sustainable in the environment, in the market. It leads to better financial decisions and minimize liabilities. Now, what future trends are we seeing in US income tax? It is shaped by several key trends. First one is definitely technology. As the technology evolves, there could be an increased reliance on digital platforms for tax collection and filing. It can improve efficiency for taxpayers and the IRS. There are ongoing discussions around tax reform could lead to changes in tax rates and structures, potentially shifting burdens toward higher income earners. So with every change in administration, change in the government, you see a lot of discussion, debates happening about what changes will be made to the tax system or tax rates. Definitely, these discussions could lead to major impact for businesses and individuals in a country. And considering we are in 2024 August as of now, there is an election coming up in November in the US. And how that goes could have a major impact on the tax structure of United States. Another key trend that we're looking at is automation and artificial intelligence. So the use of AI has increased drastically over the last 12 to 18 months. This increase in the use of AI as well as reliance on AI could influence the job market. You could also see a revaluation of current income taxation methods, how these new technologies supposed to be regulated, what impact it has on the taxpayer as well as the tax collectors. Maybe it lowers down costs so much that overall taxes can be reduced, because to maintain the tax structure is also a cost for the government. So if that goes down, then that is one area where they don't need to collect as much money to fund it. Along with this, debates about the morality of taxation. And we have seen political debates, but also economically and socially, how debates talk about fairness and equity in the tax system. Those could also create a future change in our tax landscape. So yeah, I think it is always important as a tax practitioner to keep a close look on these trends that could change the US income taxes in the future. Now let's take a brief walkthrough of how the taxes came into being, the history of taxation in the US. So in as far as back as 1861, that is the time when there was a civil war happening in the United States. During that time, to help cover military expenses, there was a flat rate imposed of 3% on incomes over $800. This was government's efforts to raise money and have enough funds to for the war against the Confederacy. This was a significant shift in fiscal policy, laying the groundwork for the modern income tax system that would evolve in subsequent decades. So it started with 3% for incomes over $800. Now, this initial income tax was repealed in 1872, so about 11 years after it was revealed. This was because people were debating over should an income tax be in place or not. So there were a lot of debates happening which persisted, and it showed the struggle of to establish like a robust tax system in the United States. 16th Amendment. So this 16th Amendment was ratified in 1913. It authorized Congress to impose an income tax without apportioning it among the states, which means, super crucial, that Congress could impose an income tax, which it will earn through in a federal sense. It doesn't need to take all that money and apportion it to the different states. So that is where federal taxation, clear distinction between federal taxation and what state levies to gain funds occurred. And this was through the 16th Amendment. Now, looking at by 1920, especially during and post World War One, this again, as you will see, the initial step was to fund military expenses. Even the second case is to fund military expenses. This was to fund World War One. It reached up to 77%. So that was how much the taxation was. It was to the need for revenue to finance the war, to support the war. This was a pivotal shift in the government's approach to taxation, establishing a precedent for future tax policies and illustrating the growing reliance on income tax as a primary source of federal revenue. So taxes became the primary source of revenue for the federal system. Now we're at the time of the Great Depression, so 1930s. So government implemented progressive taxation to address the economic crisis. which saw taxes rise for higher income individuals. So first time there were slabs in the tax rate. Higher your income, higher your tax rate. This was an idea to redistribute wealth and alleviate the financial burden on lower income groups, enhancing government revenue during a time of widespread unemployment. This was to make sure that those with greater financial means contributed a larger share towards funding government services and recovery efforts. So, a progressive tax rate, what does that mean? One is a flat tax rate. Even if you earn $1,000, let's say you pay a flat tax rate of 20%, or you earn $1 million, you still pay a flat tax rate of 20%. The other is progressive. So, progressive means as your income progresses or increases, the tax levied on you also increases. This is this is what creates tax slabs, and this is what we see in the Indian system as well. You have one rate till a certain point. Post that point, there is another tax rate higher, and post another point, there is another higher tax rate. So it creates these slabs where each income bracket that you fall into will depend on what tax you pay. The idea is to redistribute wealth, like people with more money contribute more. There are debates constantly happening around these ideas, but the first instance of progressive taxation was during the Great Depression. So after 1930s ended, that was the era of post-war. As the slabs and everything got introduced, the income tax system started becoming more and more complex. Even various deductions and credits were introduced, allowing taxpayers to lower their taxable income through specific expenses. Credits were also developed, providing direct reduction in taxes earned, further complicating the tax landscape. Throughout this era, the top income tax rate peaked at 94% in 1944, reflecting the complexity and progressive nature of the tax system, meaning 94% was not the tax on the entire income. Again, like slabs, let's say your income is 5 lakh rupees and the tax rates are as follow. Till the first 2 lakhs, you have to pay 10%. Next 1 lakh, you have to pay 20%. The next 1 lakh, you have to pay 30%. The next 1 lakh, you have to pay 40%. So even if your income is 5 lakh, it's not like you will be taxed the total 40%. Your first 2 lakhs will be taxed at one rate. Then next 1 lakh, next 1 lakh, next 1 lakh. So similarly, 94% was for the last slab or the last bracket. Income over a certain point, that part of the income was taxed at 94%, or it peaked at 94% during this era. Tax Reform Act of 1986. This was aimed to simplify the tax code and reduce rates, eliminating many tax shelters. This sought to create a fairer tax system by broadening the tax base. So, tax shelters or different methods of tax avoidance is when you don't want to contribute or pay a certain amount of tax. So, through different tactics, through different, some fall appropriately in the system. So, maybe you are following the system completely properly. Some are more in the gray area where even though you're doing things legally correct, but there is slight ethical dilemma there. So in a lot of like tax shelters that you see during today's time is companies setting up their headquarters in a country or a state where the tax rate is zero, and the way they show their income is they try to make sure that since the headquarter is placed there, that they pay as least tax as possible. So that is legally correct, or they are following the correct, like they are following the laws. It can fall in a gray area though, in terms of ethical, yes, the ethical situation. This successfully reduced the top tax rate from 50% to 28%. It increased standard discussion deduction, making it easier for taxpayers to file, led to more equitable distribution of tax burdens across different income levels. Now we're in the modern era, 2000s till now. So recent tax reforms have focused on reducing rates, reflecting changes in economic priorities and social policies. One of the ways systems and governments try to fund economic growth is that they reduce tax rates so that there is less burden on the businesses and they can invest more money into their own growth. Apologies, I had to take a water break. Recently, the Tax Cuts and Jobs Act of 2017, it significantly lowered corporate tax rates and altered individual tax brackets. The corporate tax rate, from being a flat tax rate of 35%, went down to 21%. So there was a reduction of 14% in the corporate tax rate. Similarly, it brought along other changes as well. Changes in deductions, how you can take a deduction, what amount of reduction you can take, the limits, the thresholds have also changed, impacting how taxpayers calculate their taxable income. So now that we've walked through the different changes and reforms in the tax system, let's see what all the key components of income tax. So the first one is income, your gross receipts, your gross revenue. This tax, income tax, is levied on the income earned by either individuals or businesses, including wages, profits, capital gains, and dividends. So this is any, so this is any of the revenue that you've generated. For example, an individual earning $50,000 salary and capital gains of $10,000 has a taxable income of $60,000. So all sources of income contribute to your gross income. Then deductions. You can charge some expenses, some deductions against the income or against the revenue to get to your net taxable income. So deductions would be, you can reduce your taxable income through various deductions. Common examples are mortgage interest, student loan interest for individuals, charitable contributions. Donating $1,000 to charity lowers overall tax liability. So individuals contributing to charity, that lowers their, or even for other business entities contributing to charities, lowers overall tax liability. For corporations, you will see deductions like depreciation, amortization. For corporations, any sort of book expense, if it is ordinary business expense, is more than likely also allowed as a deduction to get to taxable income. There are obviously certain differences between how certain deductions are applied for financial reporting purposes, which is your US GAAP or any other applicable financial reporting framework, and the the deductions for your taxable income. Credits. So difference between deductions and credits. Deductions reduce taxable income, and then let's say your flat tax rate is 21%. So first you get to gross taxable income, then you multiply it by the tax rate, let's say 21%, and you get to your tax owed or tax liability. Credits are dollar for dollar reduction, which means after I have multiplied 21% to the taxable income, whatever my liability is coming, on that liability, I am reducing it by these tax credits. And these are dollar for dollar reduction. So let's say I pay $2,000 and I get an energy tax credit. That 2000 I can reduce from my tax liability. So these are more opportunities or incentives that the government creates so that the individuals or businesses are investing in areas where the government wants investment, and as they're doing that, government allows them a tax credit. So maybe putting, just 1 second, yes, so maybe like spending money in research and development, and you get a research and development credit. Government wants innovation to be there in businesses, so they allow research and development, the qualified expenses, to be taken as a credit rather than a reduction. Next is, so first income, gross income, we take the reductions, we get to taxable income. Then we apply the tax rate. Tax rate for individual is a progressive tax rate system where higher income levels are taxed at higher rates. For corporate, it is a flat tax rate in the US. Lower brackets for individuals may be taxed at 10%, while higher ones can exceed 30%. After applying the tax rate, you get to your tax liability. To that, you charge your credits, or you take deduction for your credits, and the remaining amount is the tax that you're owed, and you make payments to the IRS for the tax that you owe. So let's look at few of the examples of all of these components. So income. Let's talk about how income, what the income sources would be for a partnership. So partnership divides its income in two main areas: ordinary business income and separately stated items. Ordinary includes, income from your main operations, such as sales, revenue, commission, etc. Separately stated items are items like could be like incomes or deductions that a partnership states separately, which is different from its ordinary business income, and it includes items like capital gains, charitable contributions, interest income, which is earned on investments or savings, rental real estate income. So you've put up some property up for rent, so the income earned on that. Guaranteed payments. Guaranteed payments for an individual is like salary received from a partnership. So for the individual, it is an income. Then last is dividends and royalties. Dividends and royalties are also income from your investments, or 1 second. Yeah, from your uh, investments or rights, and even that is separately stated or other than the ordinary income for a partnership. So these are like few income sources that we see for one business entity, which is a partnership.